So how do you determine your investment risk? Welcome to Unit 5, talking about investing. We have two sections. We're going to talk about the different reasons why you invest and sources for investment information, and then Section 2 will be talking about the different types of investments that you have. So we're going to look at investing for your future. Financial investment means money set aside to increase your wealth over time and accumulate funds for long-term financial goals, such as retirement. So these are different than savings. So the risk is going to be a lot different, but the return on your investment will look different than it would in savings as well. So what are the stages of investing? Well, we like to break it down into 5 stages, where you move on to each stage as you progress through the expectations of each category. So if we look at stage 1 is really just establishing a strong put and take account where you have a checking and savings accounts for expected and unexpected expenses. You have 6 months worth of savings set aside so that if something were to happen in your personal life that would affect your income, you would not have a change of your standard of living for 6 months, and that you're comfortably living out of it and you're not living paycheck to paycheck. When that's the case and you have extra funds that can be put aside, you're ready for beginning to invest. In this, you're going to invest excess savings in conservative, low-risk investments such as mutual funds, low-risk mutual funds, or low-risk bonds. When you have additional funds beyond that, you're ready to do some long-term investing, and these are going to be systematic investment options where you're saving money on a regular basis and a planned basis, and regularly about a fixed amount. So typically this is going to be for your retirement accounts. This may be an educational fund like Missouri Most for your children, but this is going to be for long-term investing, and it's set, like I said, systematically every month and then systematically the same amount for long-term saving. Strategic investing is going to be when you have additional money set aside to put into more careful management of your investment alternatives to maximize your growth of your portfolio. And this is where we talk about diversification. That means you can spread your risk among many types of investments. So if one particular investment may not do well, you have an opportunity to possibly see growth in another area. So if you continue to have a wide variety of investments, such as a wide variety of stocks, wide variety of mutual funds, bonds, maybe your investments in real estate income, and those areas all provide variety of changes throughout any particular time period, that your wealth will continue to grow in other categories. If you have continued additional monies that you can put towards investing, then you may be ready for stage 5. Very few people get to this stage, but we call this speculative investing, and this is where you're able to put additional money to be used in high-risk investments such as penny stocks, maybe art, collectibles, in those areas to see greater growth, but most certainly high risk. So why do people want to invest? Well, there's all kinds of advantages. First is that typically investing is going to help beat inflation. Over long periods of time, you can see that people's investments have grown consistently and quite excessively over years. If you take a look at any snapshot of a time period, though, you might see some small downturns in their investments, but in the long run, investments tend to beat inflation. When you have an annual growth of inflation or price levels at a 2%, most investments, if you strategically plan and process and investigate and are educationally informed on different types of investments, you can see greater returns on those investments than 2%. So once again, inflation is just that general rise in level of prices. Investing is going to increase your wealth because it does go down as an asset. So in general, investments earn higher profits than savings, increasing your assets, which will then increase your net worth, right? And then investing is fun and challenging when you can project and plan and inform yourself on different types of investments. It's kind of like gambling. There's an excitement of, did you get what you expected? Unfortunately, though, when you're working with money, if it's not money that you can afford to lose, it can create some pretty scary hardships. So by choosing investments, buying and selling at specific times can create more financial security. And then also diversification, so you don't have all your money, say, in one basket. Maybe you have investments in property, maybe you have investments in the stock market, and you can have investments in a wide variety of areas so that in any one particular category you're not at high risk of loss. So I keep using that word risk, risk, risk. Well, risk is the chance that an investment return will be different than expected. So it could be greater than you expected, and that's always exciting when you hear quarterly earnings from maybe some of these big power companies that are out there, and those stockholders then are going to go, wow, this is fantastic, they're making more money, let's buy their stocks. But then you can also have downturns such as General Motors, who's had a lot of problems with their cars and having to do a lot of rebates for customers to get people to buy their cars again. So a return is a gain or a loss of an investment in a particular period. However, short-term investments are generally more risky than long-term investments because anything can cause a change in the market on a day-to-day basis, but in the long run, investments tend to grow consistently over time. So different types of risks that we're going to talk about are in interest rate risk. So we know, we investigated through savings, that savings and CDs have a pretty low APY. So they don't bring a lot of return on your investment. So if inflation does not grow at the rate that those CDs do, then you could be losing money in those savings accounts. So when the interest rate is less than what inflation is expected to be, you may be losing purchasing power. There's also market risk, meaning just different investment markets, such as the Dow Jones during the Great Recession had a date in March where it dropped 6,500 points from 14,036. It was our lowest time it's been in a decade, and created a lot of turmoil in the market, and a lot of investors were scared and sold off, and created quite financial risk. You can also have investment risk in just choosing particular companies if you put all your investments in one company or in one particular industry, such as during the Great Recession, the big three auto manufacturers requested a bailout to help them with their finances, and many investors thought that that was not appropriate and sold their shares of stock with their company. And if you were a shareholder, you could have lost some market value. And then there's just non-market risks that could cause an investment to decline, such as 9/11, so the travel industry and the airline industry and quite a few different markets did poorly versus like the security market did very well. So it's just interesting how certain events could cause positive and negatives on both sides. Same thing with Hurricane Katrina down in New Orleans and the issues that affected those communities and how so many businesses, if you invest in a business, failed. So what are the costs of investments? And this means literally the financial cost. What does it take to get investing? So there's a capital loss, and that's a term that says that a decrease in the value of an investment below the price initially paid for it. So if you bought let's say a Apple stock at $745 and 6 months later it drops to $525, you have a capital loss in the market value of that stock for what you could sell it at compared to what you purchased it at. There's also fees associated with buying and selling of investments because they're managed by individuals. So there could be a commission, someone to actually do that transaction for you, or to increase your wealth. They may charge a third-party fee for assisting in business transactions such as buying or selling of an asset. When you deal with not money market accounts, but mutual funds, there's an expense ratio, and that's a rate that's taken to cover the entire fund to handle overhead expenses. A transaction fee may just be a flat fee just to do the transaction. So if you wanted to buy or sell a stock on E-Trade, they charge you $15 just for that transaction. And then there's front loading and back loading. This typically happens on mutual funds, and this is a percentage that is charged for your stock you buy or mutual fund, or a back load, which is a percentage that is charged for each stock that you sell. And those are just additional fees above and beyond the capital loss or the capital gain that you may get on that investment. So what is the criteria for choosing an investment? Well, you need to take a look at what is your degree of safety. What stage of investing are you in? So can you handle low risk, medium risk, or high risk types of investments? So you need to know what your risk level is. What can you afford to lose? You can never invest if you can't afford to lose that money because there's risk in any type of investment. You also need to consider the degree of liquidity, which is your ability to get your money quickly. So stocks are relatively liquid because even though I own a stock certificate, I can call a stockbroker and ask them to sell it And if I were to get a capital gain on that stock, I would be issued a check in a very short period of time. However, if I have investment in real estate and I am trying to sell a property and the property market is pretty slow, it may take me a long period of time to be able to sell that property before I can get money. So that means it's less liquid. Savings bonds and different types of municipal bonds, as well as government bonds, also have limited liquidity because of their maturity dates. What are the expected dividends or interest that I may get on that investment? So if you want additional sources of income besides the capital gain or the capital loss, you may want to consider that, and you can get those through mutual funds and stocks. You have to plan for what your expected growth is in the value that exceeds the inflation rate. So what do you want that money to go towards as far as what type of financial goal? How quickly do you need to achieve that financial goal? So then how quickly do you need that money to grow? So at what growth rate do you need it to have? So there's going to be the higher risk investments are going to have higher growth rates versus the lower risk investments are going to have lower growth rates. Is it a reasonable purchase price and fee? So if you take a look at that investment, is it a good quality market value, or is it very high price for the value compared to other market competition? And then what are additional fees that are associated? Because sometimes just the fees alone could be equal to the value or the capital gain that you get in that investment, so then you don't end up, you pay for as much as you gain and you don't really gain anything. And then some investments have tax benefits, such as real estate. You can deduct your property tax and your real estate tax from your income taxes, as well as certain types of bonds may be, and 401ks can reduce your tax responsibility if you defer that tax till later in retirement. So that means just saving or postponing your tax liability or tax deferral. All right, so what are some good investment practices? Well, you want to define, what do you want your money to do? What are your goals? So are you saving this money for retirement? Are you saving for a wedding? Are you saving for your child's education? Are you saving for a second home for retirement, something of that nature? You want to go slowly because you want to be well educated and well informed on what are the different types of investments that are out there, the costs that are associated, and such. You want to follow through. If you want to establish good financial goals, then work with a financial advisor to determine what kind of investment growth you need to have and how much money you need to be setting aside. Keep good records, because many of this is going to be needed for tax paperwork, and so you need to have receipts and documentation for all of your transactions. You want to seek good investment advice, and that can come from a wide variety of sources. So you can get it from online, you can get it through the newspapers, you can get it through great investment magazines, as well as you can deal with professionals such as financial advisors. And then know your limits. Know what you can afford to invest, because once you invest, that money is set aside for long-term financial investing, not for short-term gain. So where are some sources for financial information? Well, you have all kinds of resources through newspapers such as the Wall Street Journal. You have investment services and newsletters by all kinds of investment firms. Examples that we have are like Moody's or Standard & Poor's reports that these financial companies issue out for publication to share. Financial magazines such as Money and Kiplinger provide all kinds of financial information for just the average investor, the you, your parents and such, that would like to see how their money grows, maybe through different types of college funds or savings plans or 401ks and things like that. You could talk to a stockbroker, which is strictly just an employee of a brokerage firm who buys and sells a wide variety of securities for investors, but they know how the market is trending. Financial advisors are the ones that are trained professional planners who give overall investment advice based on your goals, your age, your lifestyle, and other factors. So they go through a rigorous training process and testing process to be certified financial advisors. So their role and responsibility is to give you advice, and then they make a commission based on your investment growth. You can look at individual mutual fund or stock annual reports, which is a summary of their financial results for the years and what their plans are for the future. And then there's all kinds of wonderful online investment education. Some of it is good, some of it's not